Okay, good evening, MBA 503 students. Like I said in the last video, in the last video we talked about the time value of money. And I'm just going to get straight into this. You'll recall that there's the future value of money, which is if you put some money in the bank today at some interest rate for some period of time, then you find out how much you'll have at the end of the period of time. The more important case is the present value of money. And the key to the present value of money is that you're asking yourself, if you have a savings goal for the future, you're asking yourself, how much do I need to put in the bank now? Present value of money is important because it's used to value both bonds and stocks in a sense. Okay, and let's get right into this. Okay, and I'm going to tell you as I go through discount bond and premium bond, I am going to do it for you right here, and then I'm going to sort of put out the elements. I'm going to write in the elements of each thing. Now, a bond is like a mortgage. Think of a bond as it's basically like almost exactly like a mortgage. Is that you make annual or periodic installments, and with a bond you make periodic installments, and then you pay a lump sum at the end. Now, we call the lump sum revenue, face value. Excuse me. Face value. This FV stands for face value. And face value is the cash flow paid back by the company at the end of the bond term. So a lot of bonds, a lot of them have 10, 20, 30-year life. I'm just using a 3-year life here to keep the example simple, but at the same time, this principle is the same. Okay, so the first element of a bond is face value, and this is the cash flow paid by the company at the end of the bond term. Okay, well, let's go down next to term. Okay, term. This is just the term, the amount of time the bond is outstanding. Okay, and I think that's self-explanatory. This is a liability now. This is going to be called bonds payable. Liability. That's the amount of time that the bond is owed. Okay, and so this is, I'll just put it here term, just to have a column here for the different. Okay, and so then let's assume in this example that the face value of the bond is $100,000 and that the term is going to be for 3 years. Okay, this is in years. Okay, so the term is for 3 years. Okay, now we have two interest rates here, and that's kind of unusual. You might find that kind of unusual, but they are, the difference is very important. Let's do the nominal rate. NR stands for nominal rate. And the nominal rate on the bond, let's say that the nominal rate, this is an arbitrary legal rate which determines the bonds and annual, and I'm going to say here / periodic. It doesn't have to be annual. We'll use years here, but it doesn't necessarily have to be annual. Periodic cash flow. In a sense, it's the amount of cash that ostensibly that you will pay out for interest. Okay, and finally, the yield rate. The yield rate, YR, is the yield rate. Now, the yield rate is the market rate of interest. And here's the difference between the nominal rate and the yield rate. The nominal rate determines how much cash you're going to have to pay, generally thought in the form of interest each year. The yield rate determines the value of the cash. There's a difference. You pay so many dollars, but given that a dollar, in our discussion of present value, a dollar today is worth more than a dollar tomorrow, the value of that is going to be determined by, of each cash flow is determined by the market. So this is the rate that is determined by, that determined, I would say, that the value of each cash flow. Okay, and I'm going to start with an assumption here. I'm going to start that with the assumption that we have a yield rate of 7%, imagine that, and a nominal rate of 5%. Okay, now there's a key rule, and I'm going to go ahead and add a couple of spaces here. Okay, now there's a key rule for bonds, and that key rule is that there's, I'm going to call them the key rules. I'm going to insert another row and even another row. Okay, and that rule is, I'm going to call them pricing rules. And these rules, I'll just go 1, 2, 3. These rules determine, are based on the riskiness of a company. Okay, so let's do rule 1. Under rule 1, there's a relationship. And what we're going to say is, if the yield rate, okay, so if is greater than the nominal rate, then the price of the bond will be less than the, I'll just say price will be less than the face value of the bond. Okay, and what is the price? The price is, the face value is the cash flow that's paid back by the company. It's like the principal on the loan. It's cash flow that's paid back by the company at the end of the bond term, in this case 3 years. Okay, and the price of the bond, which we're going to compute down here, we're going to compute that down here. The price of the bond is the amount that you actually get for the bond. Now, different companies are going to get different amounts. If you're a risky company, the market is going to demand a high yield rate, which is 7%, which is higher than the nominal rate. And that means they're actually going to give you less for the bond. It's like a punishment. You ask for $100,000 here, but if your yield rate is higher than the nominal rate, that means you're a big risk, and the market is going to give you less for the bond that you otherwise would ask. Okay, the second rule is for, so this rule reflects risky companies. The next rule reflects low risk. I'll just say low risk. Okay, and it's just the opposite of the rule I just gave you. If the yield rate, I can just put that in there, if the yield rate is less than the nominal rate, then the amount you get, which is the price of the bond, is going to be greater than the face value of the bond. Okay, and think about what that means. That means that it's like a premium. It's like a reward in a sense. If you have a low risk, that means the market is going to demand a lower yield. It's going to demand a lower interest rate. And the way that's made up is in the market, they're going to give you an extra bonus. The price of the bond will be greater than the face value of the bond. Okay, we call the first one, this is a discount bond. And this is a premium bond. And the final rule is, you can guess, it's if the yield rate is equal to the nominal rate on the bond, if the yield rate equals the nominal rate, the price of the bond let's say price will be equal to the face value. There's no discount or premium. That rarely ever happens. Usually, in almost all cases, yield rate is going to differ from nominal rate. Okay, so the first step, we're going to have 3 steps here. The first one is we're going to compute the price of the bond. And that's very important because that's going to use, we're going to be using the concept of present value. That's why present value is so important. Okay, and it's got 3 years. Okay, and then we're going to do what is called an amortization table. This one you have to be very careful with because it's something new for all of you, I think. So we'll do the amortization table. And once you have the amortization table constructed, then you can build all your journal entries, and we'll even construct a balance sheet out to the right. Okay, so let's do this. Let's first compute the price of the bond. Okay, and the price of the bond is going to be very simple. First, I'm going to move this title over here. I'm going to put period. This is the period over which the bond, this is basically the term of the bond. Okay, and then we're going to have, and then the next column is going to be your interest expense. Okay, so this is what you're going to debit in your journal entry as interest expense. This is the amount by which net income will be reduced. Okay, then I'm going to put cash flow, and the cash flow is not going to change. The cash flow is determined, as I say up here, is determined by the nominal rate, and that's going to stay the same. So that'll be sort of easy. And then finally, what am I doing? I got to correct this. Let's take interest expense out and then put cash flow over here. Sorry for the error here, but I was reading the wrong table. Okay, so we have a period, we have a cash flow, and then we're going to have, I'm going to call it a discount factor. And the discount factor is going to be based on the present value formula that I showed you in the time value of money video. And that present value formula is this formula right here. That's why it's so important. This formula is the key formula in everything we do. The future value formula is just theoretic at this point, but it serves to derive the present value formula. So that's the formula that we'll be using. Okay, so let's get back to our example here, and then the price, I'm going to say present value of cash flow. Okay, and that's going to be determined by the yield rate. Keep in mind what I said before. You're going to have cash flows, an amount that you will be paying in the future, but that's different than the value, today's value of what you'll be paying in the future. Okay, so let's get started. Okay, so let's say that we borrow, we issue a bond, which means we're borrowing money. Okay, what that's going to lead to is we're going to have 3 cash flows. And the first cash flow is we're going to take the nominal rate and multiply that times the face value. Okay, so the cash flow for the first year is $5,000. Okay, and so we're going to pay $5,000. Okay, now basically the cash flows will stay the same for years 2 and 3. In year 1, we borrow $100,000. We're going to have an entry for that. So we borrow $100,000. But then for the next 3 years at the end of each year, we're going to pay interest on that. And those are these $5,000 cash flows. So in the next year, we're going to pay a $5,000 cash flow, which is, they're all computed using that number right there. And I think what I'm going to do is actually use the entire formula throughout. And so we'll have cash flows that we're paying at the end of each year of $5,000. Just to emphasize that everything here. Now, what will be the third cash flow at the end of the term of the bond? 3 years. Well, you have to pay back the principal. So we borrow some amount at the beginning of the bond's life, and that's actually going to be the price. So once we compute the price of the bond, which will be the result of this calculation, once we compute that, that's how much money we get. But whatever the price of the bond and the nominal rate are, we're going to have to pay $5,000 per year for the end of each year. That's determined by the nominal rate. And at the end of the life of the bond, we're going to have to pay back the $100,000 face value. So I'm going to go ahead and put that in there. Okay, now how about our discount factors? Okay, I'm going to go ahead and just put in here, just to remind you, the equation for the present value of an amount that we did before. It's the amount divided by 1 plus the interest rate raised to the time. Okay, and this is the formula that we're going to be using to calculate all these discount factors here. That formula is the same formula that we use to compute the over here to compute the present value. It's amount divided by 1 plus the interest rate raised to the time period. Okay, so let's see how we do this. So our amount for the first period is equal to $5,000. We're going to divide by 1 plus the interest rate. Now here's the important part. The interest rate they're going to use to determine the value is the yield rate. Okay, so that's very important right there. Okay, so it's being divided by 1 plus the interest rate, which is the yield rate. Now, how about the time period? Now, the time period is just that 1 year right there. So we're raising it to 1. Okay, so what we've got here is 5. Well, I can show you the equation. You can see the terms. It's 5,000 multiplied by 1 plus the yield rate. Now, the yield rate is the important rate in all this, raised to B13, which is the 1. And you can see it right there. It's raised to 1. Okay, and we're using this same formula. We're actually using, to get that present, well, I must have messed up there. We're using that formula right there. Let's see where this did not work here. No, here's what we're going to do here. Is we're going to take 1 divided by, and I'm emphasizing that's actually correct what I just did, but what I'm going to do is just take 1 divided by 1 plus the interest rate raised to the 1. So 1 plus, this is equal to 1 divided by 1 plus the interest rate raised to the period. Okay, and that's perfectly fine. Okay, but I definitely want to take this dollar sign off here. And I'll probably go out 4 or 5 spaces there. Okay, that looks good. Okay, so what this is saying is that if you discount back one period at 7%, each dollar is worth 93% of that dollar. The present value of that is 93 cents. Okay, so we're going to multiply 5,000 to get the present value of cash times the factor we came up with, and I'll go over the factor in a second, and that will give us $4,672.92. So even though we receive 5,000 a year from now, it's only going to be worth, in today's dollars, given a 7% discounting, and I will go back to that formula right there. We're taking 1 divided by 1 plus 7% raised to the 1, raised to the power of 1 there. We're just saying that for every dollar you receive 1 year from now, it's only worth 93 cents today, or $4,672. That's the value. Let's do this one down here. Do one more and then we'll copy down. Okay, so the first thing you have to do is you're going to have to pay cash of $5,000. That's the first thing you have to do. The next thing you have to do is pay cash of $5,000 again. It's like annual interest on a loan. Okay, so we're going to take, using the same formula. I don't want to copy down just yet because I want to go through this one more time because I made a little skip there. Okay, so we're going to take 1 divided by 1 plus the yield rate. Here we go again. This is going to be equal to 1 divided by 1 plus the yield rate. Now this is going to be raised, as you recall, to 2 years because we're 2 years out now. And now notice, that's a good factor, and notice that as the factors go out in time, they get lower. So a factor, so that goes back to what I've been saying, is that the longer you go out, the less a dollar is worth. So if you receive $1 a year from now, it's worth 93 cents. If you receive 93 cents today, so that gives you at 5,000, that gives you 4,672. If you go out 2 years, each dollar received, even though you receive $5,000, the same monetary amount, each one's only going to be worth 87 cents. So we're going to take that 5,000, multiply it times that number right there, and that's going to give us 4,672. And I'm going to go ahead and just go through each of these formulas so you can see the way I'm building this thing. I know I could copy these down, but I just want to go and show you how these are all built. No, didn't build it right apparently. Change that to that. Okay, and that makes sense. Notice that the factors are all going down. So if you pay or receive, either one, $5,000 3 years from now, on a discounted basis in today's dollars, it's only worth 81.6 cents on the dollar, or on $5,000, 4,081.49. Okay, and finally, at the end of year 3, you have 2 cash flows. First cash flow is the interest expense of $5,000 you pay, and the second cash flow is the $100,000 that you've got to pay back. And you'll see this in the journal entries. Okay, so the discount factor here is going to be 1 divided by 1 plus the yield rate raised to 3 again. We're going to get the same factors we did in the other one. And so it once again, $1 received 3 years from now is only worth 81.62 cents. So we're going to just multiply these out. And so that's a large amount. That's a $19,000 difference right there. Okay, and now we've got to compute the price of the bond. Now we've got 4 cash flows in the bond. As you may have guessed, the 4 cash flows, the sum of the 4 cash flows is today's value of the bond. So let's do this. Let's go sum, and today's price of the bond is $94,751. That's the amount that you're going to receive for the bond. So even though basically you wanted $100,000 for this bond, because you're a high risk, your yield rate is higher than the nominal rate, which makes you a high risk, the market is only going to give you $94,000 plus $94.7 thousand for the bank. And this is a discount bond. Notice that the yield rate was 7%, the nominal rate was 5%, and the price of the bond is the price of the bond, which is 94,000.7, is less than the face value. So the rule held true, and this is a discount bond. Okay, so that is the price of the bond right there. Okay, now the next thing we have to do is what is called construct an amortization table. Now, if you even work anywhere in banking, you should know how to do this. Okay, and the amortization table tells you how the bond changes value as each payment is made, and it tells you it's going to tell you your journal entry too. You're going to pull your journal entries right from this amortization table. So we're going to make the amortization table, then we'll go ahead and make the journal entries, and then we're going to take a crack at making the balance sheet. Okay, so the first column of the journal entry is interest expense. This is the debit to interest expense. So this is the debit to interest expense that you are going to record in these entries down here. Okay, the second entry is the cash, and this is just the cash you're going to pay. And this is the cash that you're going to pay in all these entries down here once you get into the actual accounting for the bond. You see those credits to cash. Finally, I'm going to put change in carrying value. Carrying value. The carrying value of the bond is the amount the bond is worth on the books at any time during these 3 years. And you'll see what happens. But the bond does change carrying value. Okay, finally, we're going to put, I'm just going to put, you could put current carrying value. That's the carrying value after it's been changed. Okay, so let's start with the amortization table. And then we'll do the journal entries. Okay, so the carrying value is always equal to the initial price of the bond. So in this case, our carrying value is equal to $94,751.37. Okay, so we have that right there. Okay, and the interest expense, I'm going to put, and I'm just do it as a text. We're going to use the interest expense is going to be calculated at 7%. So the debit to interest expense is going to reflect, our debit to interest expense down here are going to reflect the market value of interest. Okay, and so what we're going to do is to get this year's interest expense is we're going to take the carrying value of $94,751 and multiply it times the yield rate, which is that amount right there. So, no, that's not what happened. We're going to take the carrying value of the bond and multiply it times the yield rate, which is that value right there. Okay, and I'm going to copy down, so let's go ahead and put, freeze that up right there. Okay, so if you look at the formula, what we have is any year's interest expense. So for any one of these years, it's the previous year's ending carrying value times the yield rate. Now I'm going to shrink this down just a little bit so you can see it. Okay, got to shrink it a little bit more. So the interest expense here is the previous year's carrying value times 7%. Okay, and I noticed that I froze up. I put dollars before the C and the 3 there. Okay, cash is always going to be the same. Cash is always going to be the 100,000 times the nominal rate, which is 5%. So I'm going to put in text here 5%. Okay, and these are text, so I can't use them to do equations. But what I'm trying the yield rate is what determines the interest expense. So that 7% is the yield rate. That determines the interest expense, but the cash is always determined by the carrying value. Okay, so let's go on to see how you compute the change in the carrying value. Now, this is very easy. The change in carrying value is just the interest expense less the cash that you paid. Okay, so that gives you 1,000. It gives you a positive. It gives you a positive 1,632.60. Notice it is a positive. So our new carrying value is going to be that 94,751.37 plus the change in the carrying value. So our new carrying value is 96,383.96. Okay, so let's go on. Okay, let's go on. And so you can actually, if I've got this set up right, should actually be able to just copy that first row. Make sure you got the dollar signs where they should be. And let's see if I did it correctly. And let's see if it came out, and I think it did. Note it came out fine. And how did I know it came out fine? Because the ending carrying value is 100,000. Notice that for a discount bond, you start at the price, which is less, and the carrying value works its way up to 100,000. And just to emphasize, that 100,000 equal to that 100,000. Now let's just quickly go over these formulas. That formula right there, they're all the same. And for the interest expense is the previous year's carrying value times the yield rate. The 5,000 for any year, you could just copy them down, is always equal to the carrying value to the face value of the bond times 5%. The change in the carrying value is just the interest expense less the cash. And then these are positive numbers here. All the changes in the carrying value are positive numbers. And the change in the carrying value is just the sum of the previous year's carrying value plus the change in the carrying value. And you know you're correct if your final carrying value equals the face value. Okay, so now let's go down here and do our journal entries. Okay, our journal entries are going to be as follows. First of all, the cash that you get is 94,731. The amount that goes into bond payable is always equal to the face value. Okay, so what's the difference? The difference is you've got a liability. You're going to pay $100,000 at the end of 3 years, but you're only receiving 94,751.37. The reason is you're a risky company. Whenever your yield rate, which is your risk, is higher than the nominal rate, then you're a risky company and you're going to get punished. And so this discount is a punishment. Okay, so I'm going to put the discount. I'm going to say this is equal to 100,000 minus the 94. And so there's your discount. There's your discount right there. Okay, and let's go ahead and start building a balance sheet way out here. Okay, just to show you how the balance sheet develops. Okay, the balance sheet is going to have, the first thing you're going to have, this is the liability section of the balance sheet, a bond payable. Okay, and let me write in that as discount. You're going to have bond payable, and I'm going to derive this from the journal entries. That comes from that credit right there. So that is a credit. So you're going to have bond payable for 100,000. That's that amount right there. Notice that's a credit. There it is, a credit right there. You see it. Then we're going to have minus discount. And I'm just going to put discount bond payable. Okay. Take out that equal sign. Minus the discount of that payable, which is really that account right there. And that's a debit. Notice that results from a debit entry. Okay, so that amount is going to be equal to, and I'm going to make it a negative because it is a negative, minus that amount right there. And so the new, now if you take the discount, the bond payable less the discount, and let's be clear about this, that is minus the discount, you're going to get your new carrying value at the end, well, it's going to give you your original carrying value because we haven't done any amortization yet. So if you take that amount plus that, you'll get your carrying value, your initial carrying value. And your initial carrying value, notice that it's equal to the same carrying value on the amortization table right there. Okay, now we've got 3 more entries here. And then I'll probably do a third video on the premium bond, but you can start guessing it's the exact opposite of this. Okay, so this is your entry at the end of year 1. This is your entry at the end of year 2. And this is your entry at the end of year 3. And really, this is a second entry at the end of year 3. Okay, so let's go down and see how these entries are done. And they're very repetitive. Okay, so here you're going to take, these are your entries at the end of year 1. And what we're going to do is every entry that we make is going to come from the corresponding line in the amortization table for that entry. Okay, so you know that interest expense is a debit. All expenses are debits. So interest expense this year is going to be $632.60. Okay, you know that your cash is never going to change. You're going to have to pay $5,000 in cash. Okay, and what we're going to do is this, where I have a credit to discount on bond payable, is that's going to be equal to the change in the carrying value. So I'm going to have that one right there, the debit to the change to the discount. So what's happening is every year you have to pay $5,000. Because you're a high risk, that's 7% really. This is based on 5%. This is based on 7%. Because you're a high risk, your interest expense that you're going to deduct from your net income is higher, $6,632. And really, in a sense, that we call it amortization. The amortization, the change in the bond and in the carrying value, really, as you're going to see in the discount, is the adjustment between the 7% interest and the 5% cash. So let's go ahead and see what happens on our balance sheet. If you understand the next, the repetition here, you'll get it pretty easily. Okay, so notice that we only have one credit to bond payable. There it is. So that is equal to that amount right there. There's been no other entry to bond payable. The bond payable account is not written off until either you sell the bond or until you settle with, you might settle early at some penalty, or the term of the bond ends and you just pay back your $100,000. Now the change in the carrying value is going to be negative 524, which is your previous year's carrying value, plus that 1632. Okay, so notice that your carrying value went down from 5,200 to 3,600, and of course, this is still a debit. The bond payable is still a debit, and the carrying value is still a credit, but it's a credit that went down. So if I take the bond and add back my decreased carrying value from last year, I'll get I'll get a carrying value of 96,383. I have to emphasize that this carrying value on the balance sheet should equal the carrying value on your amortization table. Okay, and now it's just a matter of repetition here, repetition for 2 more years, and the final amount here. Okay, so for the next year, your interest expense for year 2 comes from the amortization table. Your cash for year 2 is equal to $5,000, and the debit to the carrying value. Notice that the debit to the by the way, these should be credits. So sorry about that. Okay, these should be credits. Notice that I don't know why I did that mistake, but you start off with a debit on bonds payable, then you shrink it with credits. Okay, so the credit to the carrying value is 1746. Now we just have to copy down the balance sheet to see what we have here. And let's just put this up one more time. Okay, so the bond payable is still 100,000. The discount on the bond payable is last year's discount plus the discount you wrote off this year. So that's a lesser discount. Notice that your discount is going down, so your carrying value is going up, and then your carrying value this year is going to be 100,000 minus 1869.16, which gives you 98,130.84, which is equal to the carrying value on your amortization table. Now let's get our interest expense entry. Let's get our entry for the last year, then we'll do our final entry. Okay, your interest expense for the last year, 6,800, 68, 69, 16. Your cash is the same. This is cash that you're paying, which is you're going to pay $5,000, and then the amount that you're going to write off the discount for is the change in the carrying value, which is a credit. I made that little mistake there, but that's okay. Okay, which is a credit for that amount right there. So your new, on your balance sheet, your new amount is going to look like this. Your new bond amount is $100,000. That hasn't changed. What has changed is our carrying value. So if you take that carrying value and add that carrying value, this is as of the end of year 3, you're going to have a discount of 0. So your carrying value, your final carrying value, is equal to the face of the bond. But you have one more cash flow, and it is at the end of year 3. Everybody always forgets about this on tests, and I always take off 1 or 2 points to forget about it, because whoever lent you this money is going to want not only their interest of $5,000 each year, they're also going to want their principal back. So you make an entry, and that's equal to the bond payable, and you are going to pay back that same amount of cash. So in total, if you're just looking at the cash amounts, you paid the loaner $100,000 plus $5,000 plus $5,000 plus $5,000, or $115,000. Keep in mind that on a cash basis, they only loaned you $94,700. So this doesn't look like such a good deal. Is you wanted $100,000, they only paid you $94,000, and so finally, you end up paying $115,000. That 100 plus the $5,000 interest payments for having borrowed $94,000. Let's see what this looks like at the end after you paid back that $100,000. Okay, we have this right here. Okay, and so the bond payable is now that bond payable minus that debit, which is 0. The carrying value hasn't changed, and so your final carrying value is 0. Carrying value did change, but it's basically 0. Okay, and I'm just going to go ahead and copy these amounts down, these letters down, to emphasize that, I want to emphasize that the net amount is also a credit. It's, you have a $100,000 credit minus discount gives you a net credit. So let me emphasize that the result of all this in the liability section of your balance sheet are these amounts right here. And that amount right there. Okay, and so that's how you account for a discount bond. Okay, now I'm going to go ahead and let's see how much time we've used. 43 minutes. I'm going to give you a separate video. I'll send you a separate video with the premium bond, and that'll be a lot shorter because I've already talked about the basic principles. Okay, but I'll do the same thing, but for a premium bond. Okay, I know that in previous videos I said we'll have 2 videos, but I think given it's 43 minutes, I think I'll do a 3rd video for premium, and it'll be a lot shorter. I'm assuming because I've already introduced the concepts in this particular video. Premium bond is going to be just the opposite of a discount bond, and by that I mean the price is going to be higher. The price of the bond, this price here will be higher than the face value of $100,000. And keep in mind that if the price is higher, then you'll be working down toward $100,000 in your amortization table. Okay, so I'm going to put up all 3 videos at once. They're all based on the same worksheet, so that'll kind of facilitate you. But I believe that I can be more efficient by putting the premium bond video on a different video. Okay, so just wait, and in a few minutes I'll put up all 3 videos. Bye-bye.